This instructional video is an overview of the Debt Worksheet tab. Our financial model includes both equity and debt assumptions for your business. This worksheet tab is for the debt assumptions of your plan if you choose to use debt as part of how you finance your business. Debt is an important financing tool to fund the working capital requirements of an early stage business. While startups will usually not qualify for debt in the earliest stages due to an instability of revenue and earnings, debt will certainly be available, and judicious use of debt should be considered over the life of your plan if you need it to fund your cash cycle or working capital requirements. Working capital is required for any business that experiences any type of expenses ahead of revenue. If you'll be manufacturing a product prior to selling it, buying and inventorying a product prior to selling it, or delivering a service prior to invoicing for that service, your business will require working capital to finance the gap in time from when you first experience those expenses and when you finally get paid by your customer. And the faster your business grows, the more working capital it will require. Debt is a useful financing tool because it does not require you to give up any ownership of the business. However, you must prove the ability to repay with interest. In this example business model, the business is buying kiosks and placing them into the market in order to gain a revenue share of the sales generated by the kiosks. This is a very working capital intensive business model, and in the plan, once the equity is secured, the plan shows the company using debt leverage to finance the kiosk purchases and placements. First, to orient you to the worksheet layout, we have the unit data of the products we are financing at the top of the page, in this case the company-owned kiosks, followed by the three debt assumptions. Those assumptions are 1. The amount of the cash down payment made for the purchase of the kiosk, 2. The interest rate of the debt, and 3. The term of the debt, that is the length of the loan. Below those assumptions are the monthly debt tranches required to support the purchase of the kiosks according to our assumptions. Much like we did with the CapEx worksheet tab, the worksheet is set up for the potential of new debt each month to completely automate the worksheet. Now let's take a look at how we've made this worksheet and how simple it is for you to use it for your business planning. Let's look at month 7, or July 2012, as an example, the same month we just looked at on the CapEx instructional video. The total cost of the kiosk purchase of $78,000 automatically appears from the sales worksheet on row 10. And based upon our down payment assumption of 10% in the debt assumptions, the initial payment is $7,800, which automatically calculates a financed amount of $70,200. The payment details are then automatically created on rows 57 through 61 over the course of the term of the loan, which according to our assumptions is 36 months. These assumptions are then automatically inserted into the CapEx and the cash flow worksheet tabs as previously discussed, and the debt is also automatically inserted onto the balance sheet and is properly split between the current portion of the long-term debt, that is, the portion that is due within the next 12 months, and long-term debt. As you can see, the complexity of 460 rows of calculations has been done for you, and all you have to do is update any references to your sales worksheet tab for the portion of your sales you will need debt financing for on row 10, and then input your 3 debt assumptions on the scenario analysis tab. Everything else is done for you. As always, we've included an instruction section to step you through the few easy steps to complete this part of your plan.